The legal evolution and socio-economic impact of credit cards, from clay tablets to digital currencies. 1. Credit cards in the modern commercial landscape. Today, credit card usage permeates nearly every commercial transaction in the United States. At grocery stores, restaurants, and countless other venues, consumers rely on instantaneous, electronic payments using cards linked to their financial institutions. This system enables seamless transfers of credit without the need for physical currency, reinforced by digital interfaces that provide real-time visibility into account balances and transactions. Footnote: this section introduces the ubiquity and digital integration of credit card usage in modern commerce. 2. Antiquity and the conceptual birth of credit. The origins of credit precede the invention of paper money. As early as 9000 BCE, barter economies used cattle, shells, and other unconventional items as mediums of exchange. Early civilizations, such as Mesopotamia, formalized the concept of deferred payment by recording obligations on clay tablets, effectively functioning as promissory notes in agrarian economies. These records linked credit with expected agricultural yields, marking one of humanity's earliest experiments with economic abstraction. Footnote: this section establishes credit as a prehistoric construct embedded in the first human trade systems. 3. Proto-credit instruments in industrial America. As economies expanded during the Industrial Revolution, instruments resembling modern credit cards emerged in the 19th century United States. Tools such as credit coins and charge plates facilitated deferred payment for farmers during seasonal cycles. Companies like Western Union issued metal plates to select customers, limited-use instruments backed by internal credit facilities. This closed-loop model laid the groundwork for broader innovations in consumer finance. Footnote: this section details the progression from agrarian credit tools to structured internal credit systems. 4. The first operational credit card, Diners Club. In 1949, a pivotal innovation in consumer finance occurred, the creation of the Diners Club card. Sparked by an incident involving a forgotten wallet, this credit facility allowed approved members to use cardboard identifiers for transactions at participating restaurants. The program's early success expanded rapidly, eventually accommodating tens of thousands of members. This marked the formal transition from credit token to widely accepted card-based credit. Footnote: the Diners Club represented the first structured public deployment of card-based deferred payment. 5. The Plastic Revolution and Institutional Expansion. The first plastic credit card was issued by American Express in 1959, followed by innovations like the Bank of America card in 1966, which introduced revolving credit. Consolidations led to the creation of Visa, and later the establishment of MasterCard and Discover. Security advancements followed: magnetic strips, 1969, smart EMV chips, 1996, and eventually contactless and virtual payment systems. Legal protections followed, such as the Equal Credit Opportunity Act, 1974, and the Card Act, 2009. Footnote: this section traces technological and legal milestones defining the modern credit card era. 6. Legal and technological measures against credit card fraud. With advancement came exploitation. Credit card fraud, ranging from theft to fictitious card schemes, has grown into a sophisticated threat. Legislative protections, such as the Fair Credit Reporting Act, 1970, and embedded microchip verification, aim to shield consumers. Nevertheless, vulnerabilities remain, particularly with online transactions and data interception, shifting liability primarily onto issuers rather than cardholders. Footnote: this section highlights how credit card fraud necessitated technological safeguards and legislative intervention. 7. Future trends in credit and payment systems. As society transitions further into digital platforms, physical credit cards may become obsolete. Smartphone applications like Apple Pay and Google Pay are paving the way for fully virtual cards. Biometric systems, using fingerprint, facial, or iris recognition, are also under exploration. While promising, these technologies raise complex privacy concerns, especially considering the immutable nature of biometric data. Footnote: this section examines emerging innovations and the legal implications of transitioning from physical to biometric and digital-only credit systems. 8. Concluding inquiry: the ethical legacy of credit instruments. Reflecting on the arc from Mesopotamian ledgers to digital wallets, the persistent question remains: at what point did these instruments begin to facilitate predatory lending? As we contemplate the future of credit and sovereignty, this inquiry may guide upcoming discussions on financial ethics, accountability, and systemic reform. Footnote: concludes by framing credit as both a tool of empowerment and a mechanism of potential exploitation, warranting continued scholarly inquiry.